So before we jump into new topics, let's think back to what we saw last week. In the first session, we looked at actuarial reports, where some of the key takeaways were, every report should identify who the actuary was who prepared it, where did they get their data, was it checked for reasonableness, what methods and assumptions were used, and what changed from the prior evaluation, things like that. Then we had ICP 14, which was a solvency valuation where we looked at how the technical provision is the current estimate plus the MOCHI. And we had a forum question last week asking about, is the current estimate the same as the central estimate? And so, depending on which jurisdiction's guidelines you're reading, sometimes they use current estimate, sometimes they use a central estimate. And they both say, plus the risk margin. So they're the same thing. ICP 14, we also looked at, economic valuations, total valuation, total balance sheet approaches with the assets and the liabilities, and then also the discount rates that you used for the time value of money calculations. Then on Thursday last week, we looked at 2 case studies related to actuarial reports. And I'd be interested to know what people found useful, if there are any outstanding questions, because so many people, when we asked for your problem statements, had the same answer, and that was actuarial reports. So that was the whole focus last week. So anyone who is willing to volunteer, could you tell us, if you have a question or a comment about the actuarial reports, maybe something else you would have liked to have seen or something you liked especially well? Could you give us some feedback here or ask us a question? Go ahead, Blessing.
Yeah, I think last week sort of really helped from my perspective, because from having a poorly done report to a well done report, and then building to there and looking at the things that you get to ask the statutory actuary or whoever has prepared the report, for me that was very critical, because then given any report of any name, all the things to look for, no matter how structured, how different the structures are.
Right. So it sounds like the case studies were particularly useful for you. Hopefully some of you have had the chance to download the what we call the cheat sheet and found that useful as well, something you can take home when you're looking at a actuarial report and see what sort of items you should be asking about, what questions you should want to investigate when you look at the reports.
Maybe just to jump in here quickly with the question. So I'm not sure whether everyone's aware of the forums and that they are quite active actually. So if you have a question also on the topics of last week, please just post them in the forums as well. We keep checking for questions there, and the trainers have also provided some answers on the forum. So if there's anything coming up, you're also welcome to just note that down in the forums.
Good. Well, so the serious topic coming up this morning or in the next few minutes here is reinsurance. That was another item maybe that came up. The only item that came up, so maybe the first item that came up in problem statements was valuation reports or actuarial reports, and the second most common was maybe reinsurance. And joining me for this is Elias, and then after our break, we'll come back with Jules and Simone talking about capital adequacy from ICP 17. Tomorrow, we'll see a presentation on risk-based capital, and then we'll have our capital requirements case study. And then we'll have another networking coffee break. That's what we've got lined up. We're starting off now with reinsurance. We have a question on the chat. There's a mandatory standard format of actuarial report. If not, what's the best framework to learn about the most useful report? So actually, this came up in our breakout room last week with a question Usama asked. And so I did track down a couple standard guidelines, one from Canada, one from Australia for actuarial reports. And we could share that with the whole group. I will say that they're for they're really detailed. So maybe if I were reading them, I would start just by reading the bold topic headings and then drilling down into specific ones I wanted to read more about, because to read it end to end would take forever. But yeah, we tracked down a couple standard report guidelines last week, and we just need to make that available to everyone. I sent those to just Usama. Elias?
Right, thanks. Maybe also to just respond on that question, there are a couple of jurisdictions that kind of have come up with what we call an actuarial abstract, like generally what should be contained in an actuarial report. And basically, if you're coming from, I would say, a developing country, you would want, in a way, the actuarial report to kind of have some standards in terms of what do the actuaries need to report. So, for instance, I'll give an example. So, in Kenya, in particular, one of the key things that you'll be able to see that is clearly stipulated in the regulation is what an actuarial abstract should contain. And what do I mean by an actuarial abstract? These are the key areas that an actuary must report on, and the format that that particular report should be should kind of focus on. So you'll get that some jurisdictions do kind of come up with a regulation that clearly stipulates what an actual report should contain and which areas an actuary must report on, in a way that you could compare how maybe the companies are based on the results that the actuary has produced. So you should be able to see that, and maybe I should be able to send a link whereby you can see what is contained within an actuarial abstract when it comes to a country like Kenya, whereby a report should follow a particular format.
That'd be really helpful. If Elias and I can put our links together, we can provide several options for you guys to read. Thanks for your question. Okay, here we go. So this is ICP 13. We did have a module you saw this week on some of the different types of reinsurance, and you saw this presentation of key topics in that module in those slides. So we're going to quickly recap A and B, which were covered in the modules. That was, what are the overall objective of ICP 13, and what are the main purposes and types of reinsurance. And then we'll go into the topics that we didn't cover in the module. What are the features expected in a good reinsurance program, and what are the questions a supervisor will want to answer when reviewing an insurer's reinsurance program. So quickly, a slide here from ICP 13. What is the overall objective? The supervisor requires the insurer to manage effectively its use of reinsurance and other forms of risk transfer. The supervisor takes into account the nature of reinsurance business when supervising reinsurers based in its jurisdiction. So it's looking both at the types of reinsurance that the ceding company is ceding out, but also the types of, sometimes the insurer is assuming reinsurance ceded by someone else, and you need to see both. I'm going to hand it over to Elias to help us out with some exercises.
Right, so guys, let's get into this. Now, as basically Jeff has brought out, reinsurance is really, really important because it becomes an effective way in which an insurer can manage its risk profile and also capital needs. And one of the ways in which basically if somebody or an insurance company is undertaking insurance business, most of the time you anticipate for risk occurrences, but in the real sense you cannot really estimate what will be the maybe the severity or the magnitude of that particular risk. So reinsurance really plays a very, very important fact in terms of really assisting companies company's risk profile, because they're going to take different types of risks. Some risks might be very severe, some risks might be quite predictable and small, and some might be quite huge and big in terms of what they can retain. At the same time, looking into issues of capital. Now, I just want us to maybe ask ourselves, what do you think are the purposes or the reasons why an insurer will use reinsurance? And maybe you can put it in the chat, or you can unmute yourself and let us look at what are the reasons. Why do insurance companies take reinsurance? So I'm checking on the chat.
Okay, so just a quick comment. So insurers need reinsurance to enhance their capacity to take bigger risks that they probably wouldn't have been able to, and also to offset against catastrophic and gargantuan risk within their jurisdictions that can easily cause financial stress and probably insolvency for the company. Quick one.
Yep, that's great. Yep, very good point. In terms of capacity, in this case, we are talking about enhancing your magnitude to take other types of risks, or take huge risks, as Rashid has stated. Any other benefit? Yep, I'm seeing Clinton has put out that, yeah, it kind of provides us with the technical expertise. Yeah, so again, there's benefit of getting technical expertise from the reinsurer. Yep. Let me see again on the chat. Somebody is saying limits. So there's one that is TESFA is saying that there are cases where, okay, that one is on the actual evaluation. To reduce impact of financial losses. Yeah, again, here we'll again talk about the capacity, because if you have reinsurers, in a way you can smoothen out your experience. So for instance, if there are say huge claims or basically unexpected adverse claims experience, then you can smooth that out. So here, as Austin has stipulated, to reduce the impact of financial losses, that is key. To hedge exposure to insurance risk and to increase insurance capacity, that is from Noloazi. Yeah, that is great. Tulani, to transfer risk. Yep. True. You want to basically be able to increase your capacity, and the best way of increasing capacity is sharing that particular risk to mitigate huge possible losses. Yes. Again, that would ideally work on issues that we are discussing on smoothening your results. To increase business writing, within an insurer. Yeah, again, that is on capacity. Above all, if the insurer gets due recovery to settle claims, it enhances goodwill of the insurer. Again, that basically on the issues of capacity. Reinsurance from Eric, reinsurance reduces capital needs. Yep, so to protect capital basically and to reduce the risk of insolvency, it is really, really important to have reinsurance to ensure that those particular unexpected severe claims experience, or maybe large claims or catastrophic events, you are able to address those particular events. So again, reduces the impact that you would have on capital, and also basically protecting your capital. Enable an insurer to write large risks. Yep, so again, that is capacity to benefit from technical expertise. Great, that's from Eric. Maybe also to look at what Rawan is saying. This is just a question. As a supervisor, I think the first thing we should take in consideration is protection of the policyholders. So we make sure that they can get compensated properly. Yeah. Again, basically, if you're talking about the policyholder protection, the key thing is financial stability, and that ideally you should look at issues of capital. Are they capital adequate, and in the same time, are they able to protect that capital? And that's why you will be able to see that reinsurers plays a very important role in that. So maybe just to kind of bring this home, there are a number of benefits or purposes of reinsurers, and one of it is that we look at it to protect capital of an insurance company and also to reduce that risk of insolvency in cases whereby you'll get huge losses that are catastrophic. Then a company will be able to pay out those particular types of claims. The second thing is basically to increase capacity or basically to provide capacity whereby a company could ideally write larger individual risks on their own financial resources because they know they have a backup of an reinsurer. To expand business, in this case, you would basically use reinsurers to even write larger volumes of risks because you could, in a way, manage to meet those particular obligations. The other thing is that you want to smoothen your results. There are these huge claims that might come through, and just to ensure that you don't really meet those claims by your own, then it will be important for you to use aspects of reinsurance to meet those particular claims. And the lastly is basically to benefit from the technical expertise of a reinsurer. In this case, in terms of pricing, reinsurers will be very, very critical in terms of how you do your pricing, the types of assumptions, and also benefiting from data. They might have a huge set of data that can, in a way, be used to support the experience within the individual companies. Maybe we can go to the second part of this. And my question would be, as a supervisor, why would you want to look at both inwards and outwards reinsurance arrangements of an insurer? Why is this important? Why would you want to basically have a view of both inwards and the outwards reinsurance arrangements? Maybe I can get a few reactions from the chat. Or maybe you can raise your hand.
Okay. So first of all, I think as a supervisor, you want to know whether the insurance entities have exhausted the local capacity before, they see the outside. So you would like to have a fair idea of the inward and the outward insurances placed.
Mm-hmm. Yeah, that's good. Any other reaction?
Chesney is raising his hand as well.
Chesney?
Thanks for that. Maybe also just to have sight or assess the financial muscles of the reinsurance company that your direct insurer will be utilizing.
Mm-hmm. Yeah. Mm-hmm. Mark is saying by checking inward and outward reinsurance transactions important to determine whether they are made in the arm's length transactions, especially if ceding, if the ceding and the assuming companies are related parties. Mm-hmm. Yeah.
So sometimes to avoid fronting.
Yeah, fronting. And basically, what do you mean by fronting? Is that Rashid?
Yes. So sometimes the firms may just not even try to retain some of the business and just feel like, oh, this business is too great or is too risky for us to keep, and then they will just seed it out. And sometimes too, because the world is now a global village, some of the businesses emanate from the multinational companies, and they demand that the premiums are returned to them before they can allow you to have the business. So behind the scenes, they will have arrangements to say that, okay, we'll help you secure this business, but then you have to make sure that you reinsure with this, that, and at this quantity. So in order to avoid those kind of behind the scene arrangements and seeding of risk outside the country intentionally, there's the need to have these arrangements to avoid that.
Right. Yeah. So maybe just to kind of bring this home, one thing that maybe we might need to be aware when it comes to the reinsurance, reinsurance kind of brings in issues of diversification, and one of the key things that you really want to kind of prevent is the accumulation of risk. And what do I mean by this? Is that you get that there's a huge level of concentration of risk, and this could happen either on products or on geographies. So it is really, really important to be aware how the insurer is assuming risks. So if they're basically looking at quite similar risks within a particular geography, then the key thing that would happen is that in terms of seeding, that would not really materialize to what they would want to achieve out of the reinsurance arrangement. So it is really, really important to have a view of both the inwards and outwards, just to ensure that there is no accumulation of risk in a way that if somebody wanted to basically benefit from diversifying and basically getting these particular risks quite independently, if they are so much connected, then that risk will in a way still materialize, and the company would be exposed. So it is important to have a view of this as a supervisor, but also importantly, the way you've stated, in terms of the arrangements, is the companies getting their fair share? Because reinsurance is highly contractual, and all these documents that they do sign, is the board aware on what they're getting into? Is the contract in a way stipulated that it's going to, at the end of the day, protect the company? So again, the way somebody has mentioned that it should be at an arm's length, that's great. Another thing is that maybe you'll get that the insurer and the reinsurer are basically in the same country, and from that it will be similar catastrophe. So in a way, then neither they could not pay, and this is an example that we usually kind of provide. You'll get that an insurer is basically supported by a reinsurance company, and all their resources are within the same city. So for instance, you'll get that an insurance company A cedes business to a reinsurer company B, and what happens is that all their assets are in the same city. So assume that there was an earthquake in the city. The question would be, would you expect the reinsurer to pay from the rubble? Because even the reinsurer will be impacted. Now, it is also important also to look at the retrocession arrangements, because as an reinsurer, as a supervisor, an insurance company will get reinsurance, and again, the reinsurance company will look for retrocessions in terms of they're going to look for other arrangements to support or to increase their capacities. So as you also have a look at both the inward and outward arrangements, a supervisor should also focus on the retrocessions that the reinsurers are making. because as you diversify the risks further, you need to look at how the reinsurers are also diversifying in terms of the retrocession arrangements that they are having within their jurisdiction. So it's important for you to really look at all these arrangements to ensure that there's no accumulation, there are no similar risks, there are no similar geographies. At the same time, just ensure that the company is able, the reinsurers have proper retrocession arrangements within your jurisdictions. I think we can go to the next slide. If there is a question.
There's one question in the chat, Elias, from Tesla.
So the question is why the supervisor is so concerned when companies get exchanged businesses in a reciprocal way. Maybe this will expose companies for concentration risk, especially if the exchange exposure is located in same geographic location. Plus, financial soundness of companies should be considered for inward. I think this is just a comment, which is again what I'm talking about. The concentrations and the accumulations of risks will highly be dependent on how the exposures are being exchanged, and if they are basically from the same location, you would expect an impact to happen to both the insurer and the reinsurer. The key thing again is on, I did mention areas of retrocessions as a supervisor. You should also be keen to check on the retrocessions that the reinsurers have in terms of diversifying the risks. It was a comment, right? So, Chesney, do we have jurisdiction that allows fronting? I think most of the jurisdictions kind of inhibit or prohibit fronting because one of the key things that you don't want an insurance company to do is to act as an agent or a broker for a reinsurer. So you'll get that most jurisdictions do prohibit fronting, and ideally fronting can only be allowed by approval from the regulator. And in that case, how that happens is that the regulator has to be satisfied that the company has checked across the jurisdiction that there is no capacity to underwrite that type of risk. So, and also there should be some evidence that you've kind of contacted different providers that might have capacity and they have declined that risk. So that is the only way that you would allow fronting. So most of the time, I don't know whether there's a jurisdiction that allows fronting, and in a way it is prohibited, and it's only allowed where there is no capacity and there's proof that that capacity does not exist. Right, I think we can go to the next slide. Great. So maybe this is just another question, and maybe in the with the types of reinsurance that you might be aware of. Here we are talking about an insurer and a reinsurer sharing a predetermined percentage of both premiums and claims, and typically you'll get that the reinsurer pays reinsurance commissions that are basically reimbursed to the insurer for the agent's cost, commissions, and other incurred costs. So maybe what type of reinsurance is this? If somebody would mention, you can put it on the chat. Yeah, Clinton is proportional. Any other? Maybe you have a different type. Maybe you are thinking it's some different type of reinsurance class or business. All right, this proportional because here what we are looking at is ideally proportional sharing, or most of the other time it's usually called a quota share, which has been said by Addison, right? Great. I think I can go to the next slide. Yep, so let's discuss this. What type of reinsurance is this? Whereby the direct insurer retains the cost of claim up to a certain point, and the reinsurer pays the excess. What type of reinsurer is this?
Excess of loss.
Maybe you can put on your video, you know, we want to see you.
Do you have your camera, Eric?
So it's non-proportional, but again, we have different ways in which this can be done. You can have an excess of loss. You can have for whereby you want to pay for a single event, the cut, and also you can talk about the stop loss. So there are different types of non-proportional reinsurers, and here you can see 3 different types based on the types of calculation that an insurer might want to undertake. Right, so there's a small exercise here. So here we are talking about an excess of loss, and in this case, the reinsurer indemnifies the cedants once a claim exceeds a predetermined limit, and this is whereby it only applies to the claims per event or policy. So there's an example here whereby there is an excess of loss property treaty where a reinsurer pays the cedant 250 in excess of 500. So what will be the retention under the excess of loss treaty? What would be the retention? Yeah, it's 500. That's correct, Mark. So assume that the original claim is 600. What do you expect the reinsurer to pay? Right, the reinsurer will only pay 100 because the thing here is that the company will only retain up to 500, and in this case, if there's a claim of 600, the reinsurer only pays above the 500, which in this case is only the reinsurer will pay 100. So in case where in the circumstances whereby the claim was say 450, the reinsurer then won't be obliged to pay in such a circumstance. Right, I don't know whether there's any other question before I take it back to Jeff. Any other question, or maybe a comment on fronting? There's a question whereby somebody was asking whether there's a jurisdiction that allows fronting. Maybe you can share the experience in your jurisdictions regarding fronting. If that's allowed, then it could be good if we could hear that. So Cesny, maybe you can have your mic on. You've lifted your hand.
Thanks, Ellis. I hope everyone is able to hear me.
Yep.
Yeah. So I've got another question. Actually, that's where my question on fronting came from. So I just want to understand whether in your jurisdictions do you allow your direct insurers to also conduct reinsurance business? Because that on its own, you'll find yourself in a position where you've got a group of companies, maybe you've got 5 or 6 insurance companies within one group of companies, and then maybe 1 or 2 of those direct players, they also allowed to conduct reinsurance business. So they we end up having a concentration of risk because the other direct players will be reinsuring with their fellow subsidiaries within the group. So there's concentration of risk there, and there's also an element of fronting. So in South Africa, we do allow direct players to also conduct reinsurance inward business. So I just want to find out whether is that the same with other jurisdictions. Thank you.
Yep, there's a question there. So maybe we can get reactions from different countries before I can make some submissions. Maybe Kenya, maybe Uganda, Ghana. What is the experience? Maybe you can unmute. You can just unmute yourself, put on your video, and make a submission. Right, there's Eric.
Elias, in Kenya, can you hear me?
Yeah, we can hear you.
Yeah, in Kenya, we don't allow fronting. Actually, we require the insurance company to retain part of the risks. Yeah.
Mm-hmm. So fronting not allowed in Kenya, it's prohibited. Ethiopia, I think there's prohibition of fronting. All right, I think if you look at what Cesme is saying, and I can let me give an example. So, for instance, you'll get that a company like Sanlam in South Africa has an insurance called Santam, right? And you'd get that these two companies are a group of companies. And most of the time is that maybe the insurer gets business, then it reinsures it with a reinsurer in the same group. Thereby, you definitely be able to get some instances of what we call a concentration risk. And what maybe a supervisor also needs to focus on is on how, again, the reinsurer, in case they're in a group, kind of looks at their retrocessions arrangements in the circumstances whereby you can get such an incidence, because you can get that an insurer and a reinsurer in the same group, and also the business is being passed to that particular reinsurance company. So the key thing in this particular case would be to ensure that the retrocessions are well aligned, because you'll be able also to get that other companies within your jurisdiction will be basically reinsuring with this one reinsurer. Now, in terms of co-insurance, and this is something that you'll get in a number of jurisdictions, whereby there are businesses that are co-insured within between different companies. The key is that the regulator has to ensure that there is capacity for those particular companies that are having these co-insurance arrangements, and also within the proportions at which the co-insurance is being done is commensurate to the capital levels that that particular company could sustain, just to ensure that, again, there's no exposure of those particular clients that might really have a big risk and might require it to be co-insured between different companies. The key, and maybe what I would basically advise Chesney, is that you need to be aware of the retrocessions. That is really, really key. And again, maybe out of the governance practices that a company within a group that might want to reinsure its business with another member of a group, they must be proper governance in ways in which how our recovery is done, how are the commissions done, and also just to ensure that the reinsurer within the group is not just taking the risk because it's just coming from another member who is an insurer without really doing their due diligence. So governance will be quite key, and that the supervisor must also be at hand to ensure that the governance practices are top-notch and they are all observed. At the same time, how the retrocessions are basically being managed in such a case whereby there are a number of companies within a group, and there is reinsurance and co-insurance within the same members, within the same members of the group. Generally, in different countries, I haven't seen fronting being allowed until circumstances whereby there is no capacity, whereby then a company will be allowed to front a particular risk, or and that has to be approved from the regulatory level, because also they have to check whether the insurer is only interested on the commission, because some risks would be huge, and the only thing that maybe an insurer is focusing on is the reinsurance commission, and that's it. So again, to ensure that there is no flight of premiums outside your jurisdictions, then the supervisor must be really keen to check on how on whether there is no capacity within your jurisdiction. Right, thanks, and let me then pass it back to Jeff.
Thank you, Elias. So we have a few more examples and exercises coming your way. That was kind of a wrap-up of everything you might have remembered from the modules. And we're going to move in now into some new topics, beginning with what are the features expected in a sound reinsurance program, and then we'll end with what are the questions the supervisor would want to answer when reviewing reinsurance programs. So reinsurance program design, these are mostly centered around credit risk of the reinsurer and making sure that claims get paid, that the capital is safe. So the first point here is ceded so that the net risk retained by the net retained by the ceding company are commensurate with the ceding insurer's financial resources and risk appetite. So it's a holistic view here of the risk appetite and risk management system of the ceding company. Financial strength and claims payment record of the reinsurers in question, both in normal and stress conditions. So it's another way of saying, you know, what's the credit rating, for example, of the reinsurer? Can they pay claims under good circumstances first, and then also what happens when there's a catastrophe? Levels of exposure to a single reinsurer or different reinsurers being part of the same group. So if you have a ceding arrangement with one reinsurer, it doesn't hurt to look and see what are the, as a supervisor, what are the retrocession agreements that reinsurer has, because the risk might end up being paid eventually in a roundabout way through 3 or 4 transactions right back to the same jurisdiction, or even the same insurers, just trading risk among themselves, and there's no diversification. Extent of any credit risk mitigation in place. Actually, Elias, do you have any examples here of, or anyone else listening, what an example would be of the credit risk mitigation?
So I think when we talk about credit risk limitation, and the key thing that you need to think about as a supervisor is how so for instance, the recoveries are done. You'll get that most of the time, the recoveries might take time, and you'll get that the insurer pays expecting the refunds to come, or to recover from the reinsurance company. So with that delay, there are elements of credit risk that might arise, because one, in case the company was supposed to invest these recoveries, or maybe they'll be losing some level of investment return, given that they have not really been able to recover their monies in time. So the key thing that maybe a supervisor would definitely be checking is on how the recoveries are done, the time taken, and the reinsurance outstanding, it will be very, very key for the purposes of supervision.
Right. So it sounds mostly like if there is a catastrophe, for example, that impacts a lot of claimants, you don't want to tie up the transfer of funds by having to look at all the every single claim. Maybe you have a set amount of money that's available quickly to speed up the transaction, and in the background then allows more time for all of the detailed underwriting and claims, not underwriting, but the claims processes to occur. But you want to be able to pay claims more quickly than waiting for the whole insurer versus reinsurer back and forth to occur. I think that's what I understood. Let me know if I got that wrong. I don't see any comments in the chat. Clinton?
Yeah, so okay, with the extent of credit risk mitigation put in place from the supervisor's point of view, as Elias was saying, sometimes you like to monitor the duration for the reinsurance recovery. So in Ghana, what actually happens is as part of the quarterly returns, we expect them to report reinsurance recoveries which have exceeded 60 days. And in rare cases, the commission may force a particular insurer to tone down that number of that amount of outstanding reinsurance recoveries before they can place any further reinsurances with the said insurer.
Okay. Thank you, Clinton. Anyone else have a comment on this slide? Actually, there's one more point on this slide, but I think it's just a lot. It's very similar to another point we've already seen. The expected resilience of the reinsurance program in stress claim situations, including stress related to the occurrence of multiple and/or catastrophic events. So that's similar to the second bullet point on this slide. Any other comments or question here? We do have an exercise on the next slide about a catastrophe protection. Not seeing anything in the chat. So in this exercise, you are reviewing the reinsurance arrangements on a number of insurers, focusing on how they are protected against the risk of a major flood. So first, we're going to look at life insurance. That's point A, and then in B, we'll look at general insurance. So for a life insurer, how might the flood affect the different classes? What I mean by classes here are, think of types of insurance that a life insurer would offer: life insurance, disability, medical. So how might the flood affect the different lines of business of insurance, and what reinsurance cover might be appropriate? So if it helps first, just think about life insurance, and then maybe offer an answer as well for medical and disability and anything else.
Okay, so for a life insurer, I will be expecting a proportional reinsurance arrangement, because looking at the flood, if I go and peg it, maybe I use the excess over loss and I peg the amount of claims that I'm expecting, or I actually cap the amount that the reinsurer is supposed to pay, is going to affect the insurer that much, because in a rare case scenario, maybe I go for 1 million Ghana cedi or $1 million US sort of excess. Afterwards, you can come in as a reinsurer. But then if I go in for a proportionate, and then because of the flood, I have a whole lot of claims happening, I know that 30% is covered by the reinsurer. I just have to pay the 70%, because in such cases the impact could be huge on the typical life insurance policies, being it medical, being it total permanent and disability, or a whole life policy.
Right. So if there was a major flood that caused a lot of mortality, way more than they would expect, more deaths for the insurer than they were expecting for the year, proportional could help, but non-proportional, like some sort of aggregate stop loss or aggregate XOL, so that once claims hit a certain level, the insurer knows we're in trouble if we have to keep paying claims. If we're expecting 200 deaths this year and we have 600, we're going to be in a lot of issues paying claims and a lot of solvency issues. So that would be a good time to use some sort of aggregate protection with an aggregate retention limit, like stop loss or aggregate excessive loss. But certainly proportional would also help. But for catastrophes, really, something that protects the aggregate amount of claims for the entire pool of business would be certainly help the insurer sleep at night and the supervisor as well. A question or a comment here in the chat. The flood might impact the number of persons impacted, right? So you have way more mortality than you would have expected at the beginning of the year. Clinton, your hand's up still. Did you have any more comments?
Okay, so what I had wanted to add is if I'm going for non-proportional, then it's about the type of non-proportional I'm going for. Because if I'm going for excess over loss and I've capped it, I've done 1 million excess over 2 million Ghana cedi, then that way there's still going to be a problem. So I think, as Jeff said, the aggregate will help in this regard.
Right, yeah. For catastrophes, you love to see that aggregate in place. What about anyone have any comments on other types of business that a life insurer may offer? The two examples I gave, there are other examples. The two I threw out were disability or medical. Rowan, for life insurer, flood will affect life, medical, disability, and the cover is non-proportional reinsurance catastrophic protection. Right. I kind of gave away the answer. What I said for the life insurance kind of applies to all three. Proportional is always good. Proportional always helps. It has benefits for sure, even when there's a catastrophe or not a catastrophe. But for catastrophes, you have a lot more claims than you were expecting, and the size of the claims may be larger. We can look at part two here, the general insurance, or if anyone has any more comments on the life insurance on part A, go ahead. But let's think about some of the lines of business that a general insurer would offer, and how might this flood impact, and how can reinsurance help? And Elias, feel free to jump in if I say anything you disagree with, or you want to add some more background or clarifications.
I think maybe just so, for instance, when you talk about flooding, just think of a city, and I know. So, for instance, there are different cities that kind of flood, and definitely there's one area around the city, Nairobi, that gets flooding. So one of the things that you'll get that all the motor vehicles are submerged, and the walls have fallen, the trees have fallen, they'll be falling on some stuff, and in this property, definitely. So just think about, say, different lines of business, and then out of that, if all these vehicles kind of are submerged and the walls came crashing and definitely destroyed other properties, and basically you'll be able to get injuries. Some people will be injured, and some people might require hospitalization. So think about those types of classes of business, and maybe how would you reinsure to protect an insurance company. I think that's a hint there.
So Chesney says motor and property, maybe exactly that's what Elias was saying. and the best reinsurance would be non-proportional. I agree. Tespa says, depending on the location of life and, excuse me, I'll slow down. Depending on the location of life, assured living or working in the policies covered in that area may be considered what type of reinsurance arrangement is required. The large number of exposures are located in the same flood-prone areas. Non-proportional stop loss can be arranged. Same to general insurance. The only other kind of line of business for general insurance that I thought of would be business interruption insurance would also be impacted by flooding. Okay, this was just some of the answers we've already discussed. Clinton, personal accident, yes, also from flooding, as well as medical. The slide looks at some more of the reinsurance program design. The topic here is retention. So we're trying to determine how much risk to retain or to cede. Well, retain, or the opposite of retaining is ceding, is very important when designing a reinsurance program. The concentration risk. Is the company heavily exposed to a single risk or an event? Does it only insure coastal properties? I think that's what we saw in case study 1 was, I think the disaster was a typhoon maybe. And both the insurer and the reinsurer were in the same area. Risk appetite. Retention strategy is an expression of a company's risk appetite. So if the company's risk appetite is, $1 million policies, you don't want to see them starting to write $10 million policies just to, gain market share, unless you've got the board has determined that the risk appetite has changed. Incentives, the cedent must retain an incentive to manage the business. So for example, no 100% reinsurance. So we've already talked about fronting quite a bit today, which would be the 100% reinsurance. I would say that, the US is a little different. We have, 50 states and there's 50 regulators in the 50 states. And so if an insurance company wants to sell in multiple states, sometimes they use fronting so that if a company is, for example, licensed to sell one type of insurance in this state, but they want to sell a different type of license, a different type of insurance in another state where they don't have that license, they may basically use another insurer as their agent that has the license they need in that other state, because it's a faster way to meet the regulatory requirements of all 50 states if you can partner up, and it's basically fronting. So the objective isn't to diversify the risk, it's just to meet the approvals to get the insurance sold. But as far as risk transfer, 100%, sounds like it's not allowed unless, like Elias said, that there's no capacity for a certain line of business within the country. Market terms, the cost and terms of the reinsurance cover available. Claim costs, consider the range of possible claim costs and the probable maximum loss and compare that to your risk appetite of the company. And finally, priority. If you have multiple reinsurance arrangements, who pays first, who pays second? How are the benefits coordinated? That's what is meant here by priority. Looking at our time, we have 15 minutes. We're doing okay. I do want to keep moving unless anyone has a question on this one. Internal controls of reinsurance. We have a couple, by the way, we have 2 more slides here on different reinsurance program design issues, and then we'll get into the last 2 slides. We'll look at what should the supervisor be looking at in reviewing reinsurance arrangements. Font is so small. The reinsurance program should be part of the ceding insurer's overall risk management system and internal controls. That's right. Looking at the reinsurance system holistically, reinsurance is one part of it. Consider its appetite for reinsurer credit risk, and so you'd also want to consider, what is the credit rating of your reinsurers. If your risk appetite says you're not going to use anyone below a B rating, you shouldn't be using B-. Procedures for identifying reinsurers that meet its security requirements. So security here is not the number of police, it is the financial strength of the company. Set guidelines reflecting security and size of the reinsurer in relation to its, by its we mean the ceding insurers, in relation to the ceding insurer's maximum aggregate exposure to any single reinsurer. Consider the risk posed by a mismatch in terms and conditions between the reinsurance contracts and the underlying policies, such as one-way termination clauses and limited reinstatements. Right, so for the limited reinstatements, the topic here would be, once you reach the limits of a reinsurance contract, can they reset? If you've hit the maximum, can it be reset? How many times can it be reset? And to reset it, does the ceding company have to pay more reinsurance premium? That'd be a reinstatement, just kind of resetting the terms of the contract. Appropriate criteria in place for the purchase of facultative coverage. So this was something we haven't talked about today, but you did see it in the modules. That's the difference between treaty versus facultative. Treaty, you've got the terms in place. Every policy that's sold, it's already automatically determined whether the insurer and the reinsurer are gonna transfer risk on that policy. Facultative is more one-off basis, where the reinsurer is not obliged to accept the risk transfer, and the ceding company is not obliged to make it. It's more of a one risk at a time. Processes and controls to document the principal economic and coverage terms and conditions. They should be clear. And are there the commercial risk management and technical skills required to secure an appropriate risk reinsurance deal? Our last slide here on design, I'm going to hand it back over to Elias, and this is on liquidity. Elias, did you have anything on the last couple of slides that you wanted to mention?
Yeah, so I think then, great. So one of the things that I think maybe we might need to bring into the discussion, if you look at various jurisdictions, you'll get that there is a state reinsurer. And what happens is that most of the time, the regulator or the government have decided that there is a portion of business that basically has to be passed through that state reinsurer. Now, I just want to kind of bring this in terms of what then, if that is the case in your jurisdiction, what maybe you need to kind of have a view at, because I know it's there, and there's a lot of protectionist kind of policies when it comes to the reinsurance processes. And there are a couple of points that Jeff has relayed on this, and one of the issues that here we've seen is around overall risk management and internal controls. Though that the business has stated that there's a mandatory alignment of seeding, the key thing that maybe as a supervisor, you need also to really be keen on the process and how those particular state reinsurers are organizing their business in terms of is it basically within their risk appetite? Is it basically, even if that business is being taken to them without through the regulations or through the law, are they basically building their risk management systems? Are they is the business within their risk appetites? Have they really managed to get proper retrocessions, which is really key, because if the supervisor is not aware of some of these retrocessions arrangement, then even if the law is trying to protect your market, whereby you are not ceding much outside the country, you might end up bringing a lot of concentration within the business. Another key thing that also is important just to mention here is in terms of the credit worthiness of the reinsurers that maybe different companies are dealing with. It will be important to look at their ratings over time, and also just to ensure that you kind of also understand what drives those particular insurers that are operating within your jurisdictions, because you'll get that there are companies that use reinsurers that maybe you've never heard of, you don't know, you just came across that name in the submission that they have made. So it's good to do some due diligence on the reinsurers that do operate within your jurisdictions, just to ensure that there is no exposure in terms of security that maybe a company might want to get from those particular insurers. Something that also you might also be keen about, you need to, because reinsurance arrangements is kind of like a requirement to some of the insurers. They don't see it as protecting maybe their capital and their risk profile. So you just also need to ensure that the reinsurance is not taken as a compliance exercise, because some insurers might just want to have it as a compliance tool rather than a risk management tool. So you also need to be quite keen on, as a supervisor, whether an insurance company is taking reinsurers just to comply with your laws, or is it really providing value? And that's why when we talked about the contracts that they are signing, they should also be able to demonstrate value, that this is a value that you are deriving by reinsuring these particular risks to these reinsurers. Right, so I think I can go to the next slide. Yeah, there's a comment here. Let me just check whether it's a question. I think that the reinsurance program represent a part of the ORSA process and must fit the strategic objectivity of the company within the risk appetite. What is the main interaction between reinsurers and ORSA, and how the board can play an active role to implement good reinsurance programs. Now, the board is key. The overall own risk and solvency assessment plays a critical role on insurance. And what basically needs to come in mind when maybe you are doing an assessment on the board is issues around reinsurance optimization and the reinsurance adequacy. The board should be able to demonstrate that that out of the reinsurance arrangement that they're having, they have optimally selected them, and they are adequate to the exposures that they are getting. And that's why I talked about in my previous comment the value that an insurer is deriving from an insurance process. So the board plays a critical part. And one of the things that maybe you might see in other jurisdictions, the companies are required to provide what is called the reinsurance adequacy certificate that is signed by the board and the independent channel. It can be an actuary for the purposes of demonstrating to the supervisor that the reinsurance arrangements are adequate and the board is fully aware of what they are getting, and they properly understand the arrangement or the structure that they have in place. Right, so in terms of the reinsurance liquidity, it is really critically important to ensure that the reinsurers are able to fund all the valid claims under the contract of insurance that has been written. And here, there's a way you could test this by basically reviewing the level of recoverables that maybe a particular insurer is expecting to get from a reinsurance company. So that is key. Another thing is that, it's good to look at the claim sizes in terms of whether they could give rise to cash flow difficulties and even delays from a reinsurer's perspective. And this could be tested over time, dependent on how, basically by looking at various numbers out of the reinsurers in terms of how much are they basically settling with their insurers and how much is basically outstanding. Key thing, also look at the clauses that trigger these payments, because most importantly, you'll get that sometimes insurers do sign contracts that they don't understand and might not even pay at all. And that means that if those clauses that might trigger payments are not within the contract, then again, that might lead to liquidity issues both on the reinsurer and the insurer side. At the same time, use of collateral and kind of deposits accounts to basically meet some of these needs that might be required from the insurer's perspective. So are there collaterals that have been put in place? Are there deposit accounts that have been created between these two parties for the purposes of accessing these particular funds? How quickly can these funds be assessed? And what types of collateral do we basically have in place? So we can look at this exercise. So the exercise is that given the preceding discussion around the purposes of reinsurers, the features and different types, and the issues around program design and internal controls and liquidity, list 4 questions that a supervisor should be trying to answer when reviewing an insurer's reinsurance program. So assume that you get your insurance arrangement and a reinsurance program. What type of questions should you be asking yourself? You can put it on the chat. Or maybe you can raise your hand. I usually like more discussions. So you can just put on your video, raise your hand. Let's discuss this. It will even save us time, guys. Yeah, Clinton.
Okay,
then
so
Eric can come after you.
So I will be looking at how diversified the various reinsurers the insurance company is playing their business with is. So if you have quite a number of reinsurance arrangements and all the risks that you are insuring are with one insurer or just a couple, I'll be looking at that. The other thing is the correlation of the risks being insured, whether the reinsurance arrangement you are picking actually conforms to the class of business and the nature of the jurisdiction, whether there are some catastrophic events and all that. So you factor that to know, okay, where a proportional be ideal, where non-proportional be ideal. I'll also be looking at that. And I mean, I think first and foremost, what I should be even looking at is the risk appetite of the insurance company in the first place. and how the risk management controls they correlate to the whole reinsurance arrangement. Yes.
Yeah, great. So definitely, what yes, Clinton is saying is that it's important to have a sight on the risk appetite and what basically would inform the level of arrangements that they need. And also, he mentioned that he will be quite keen on whether each line of business conforms, or basically they're taking the right types of reinsurances for different lines of business or products. Okay, fine. I know there are ladies in the room. We are going to get to the ladies, so don't worry. So let me go to Eric, and if there's ladies, let's talk about insurance too. So Eric,
I think one thing that that higher supervisors should review is asking how much is being retained by the insurer. So maybe the insurer is retaining little or is retaining a huge amount. The other thing is also to ask on the liquidity of the reinsurer.
Mm-hmm.
Yeah.
Mm-hmm. Yeah, that's great. So the ability versus retention to ability to meet the obligations from the insurers. Yeah, that's good. Rashid.
Okay, in my opinion, I think the credit worthiness of the reinsurer or the credit rating of the reinsurer is also key, as well as the experience of the insurer. Both the insurer and the reinsurer's experience will count, because there are some reinsurance arrangements that just wouldn't fit new firms who lack experience and they haven't really spent so much time underwriting, or they are new in the industry. There are some reinsurance arrangements that just wouldn't fit for them. So I'll look at the experience and then the credit worthiness of the reinsurer. Thanks.
Yeah, great. So here, what Rashid is talking about is the credit ability of the reinsurer. So in this, looking at its credit worthiness, its credit rating, that is important, and also it's mentioned something to do with the experience, the level of experience that maybe the reinsurer possesses, and how that would really impact the business. Yeah, so I think maybe as I'm waiting for ladies to raise up their hand, I assume that, yeah, they have decided to be digital. They are only chatting, right? So there are two comments here. Al-Masri talks about the rating of the reinsurers and the insurance products that are covered out of the different arrangements, and in this case, mentioned reinsurance treaty arrangements. TESFA, the composition, particularly of the risk profile and the type of reinsurance arrangements for various classes, that is key. The retention level in line with both the capital and the free reserves. And again, who are the reinsurers? Who are we dealing with? So that you are not dealing with somebody that you are not dealing with people that are not you might not be aware of in your jurisdictions. Abel Sata, I think mentions of the threshold of reinsurance program, how to justify what's the type and the threshold of reinsurance program, how we justify these choices, and how the reinsurance program help reduce the overall risk exposure, and how the company monitor the reinsurance program. All these are very important points, and I've liked what you brought in, particularly on how the company monitors the reinsurance program. Now, in and this is something that you might need to check out as a supervisor, not only reviewing the risks and the internal controls, but also the reinsurance function. There are other jurisdictions that have gone ahead and require a company to demonstrate that the reinsurance function is well resourced and functional, just to ensure that the company is aware of their insurance programs, and they could monitor that over time. Not that they are gotten by surprise that, okay, fine, there's a big risk and everyone is running around. Maybe they might not even be aware of what they need to collect from their insurers. So it's important to basically monitor that over time. So maybe just to bring this home, it will be important to know the insurers that you are having. They should be of high quality. You need to look at the reinsurance management strategy, particularly on different businesses and risks, and whether there's a philosophy. There you should be able to see the risk appetite. There should be some roles that needs to be taken, and in this case, the insurer and the reinsurer under the contract arrangement. What will their roles and what will each and every person be doing, and how then does it fit to the ERM framework, the enterprise risk management framework. The controls are also key, and whether those particular controls are sufficient, and whether all the requirements and the procedures that have been set are fully implemented by the insurers. And again, you need to look at the impact, whether there is a genuine transfer of risk. I did mention earlier, you need to be very sure that this particular company is not just acting for the purposes of just receiving the reinsurance commissions. Lastly, and this has been mentioned, the liquidity, particularly being able to maintain that your company or the company is able to get resources to meet their obligations, and whether that particular insurer has some assets and where these particular assets are maintained. And so it's really, really important just to have a view of even the types and the nature of assets that the reinsurers do have. Right, so I don't know whether there is any question on this. I can still see 2 hands raised, or 3.
We can also take questions in there's a forum for reinsurance. If we run out of time here, we are a little bit over. So definitely, if you have a question that didn't get answered today, put it in the forum, and then Elias and I can respond there. Looking forward to having Elias back with us tomorrow as well in tomorrow's sessions. We're going to have 15-minute break now, come back, and we're going to hear from Simone and Jules talking about ICP 17, which is capital adequacy.